Welcome to the first Sterling Trading Tech Roundtable video series. My name's Andrew Actman, and I'm the Managing Director of Sterling Trading Tech. As a global provider of trading and compliance solutions, we thought it was important, especially during this time, to continue to have conversations about the industry. This roundtable will be focused on risk and margin management. We invited 3 industry risk managers to the roundtable to understand how they are navigating both risk and margin during this unprecedented time. I wanted to thank each of them for joining us in this roundtable discussion. Starting with Freddy, please introduce yourself.
Thanks, Andrew. So happy to be part of the panel. Had a lot of experience with folks like Securities and GSEC, Goldman Sachs Execution and Clearing, Merlin Securities, Wells Fargo, Apex most recently, and a lot of experience with both trading floors, New York Stock Exchange, Chicago Board Options Exchange, Pacific Exchange, and a lot of background dealing with market makers and risk and hedge fund managers and risk. So happy to be part of this panel. Thanks, Andrew.
Thanks, Freddie. Terry, why don't you tell us a little bit about your background?
Likewise, Andrew, thanks for joining me, allowing me to join the panel. It's a pleasure to join everyone here. Like Freddie and I have both kind of grown up together in the same industry, same places, same family of companies. I used to manage the risk, all the risk for the prime brokerage and clearing space for Goldman Sachs and its Securities. Currently at Sumo Capital and Budo Group as the acting chief risk officer for those 2 firms, where we are a pretty large proprietary firm in listed equities, equity options, futures, and futures options.
Thanks, Terry. And last but not least, our loan clearing firm representative, Nicolas.
Hi, thank you, Andrew, for having me. So I'm Nicolas. I've been in the clearing space for about 15 years, overseeing everything from operations, settlement, risk, trading, and I'm happy to be here to answer any question.
Thanks, Nicolas. And with that, I'd like to pose the first question of this roundtable to Freddie. And Freddie, this can really be viewed as how does a custodian or a retail brokerage firm identify a risky client? What parameters do you utilize to identify really risky clients or risky strategies?
Thanks, Andrew. Yeah, I would say that, risk managers are looking at really 2 things throughout the day, right? You have your day trading risk and your end of day risk. And the day, I should say intraday risk, you're really looking at open order exposures, gross open order exposures, and gross notional exposures. And if the market were to move, let's say 5 or 10% in either direction, what does that do to the firm? What does that mean to the client? And understanding that risk. At the end of the day, now you're really looking to make sure all of your clients are tucked in, generating reports so the top of the house or the top of management understands which clients could possibly be in a risk call or margin call coming in the next day. Taking a step back, I think custodians, large and small, look at risk differently, right? So I've had the pleasure of working at the Goldmans like Terry and Wells Fargo, where they have massive balance sheets, massive headcount, and big budgets. And the way that they think about risk is completely different than a smaller firm that's got less than $200 million balance sheet, where they have a smaller headcount, they don't have big wallets, and and they don't have a big balance sheet. So their concerns are really like at the end of the day, like what's our OCC requirements going to be? What's our NSCC requirements going to be? What's our broker reserve calculation going to look like? Are these clients representing a lot of firm risk? So there's really a bifurcation between those 2 type of custodians in the way they think of risk. And to your question on parameters, it's funny, we came up with a what we call the worst case scenario or worst case client parameter when I was at Merlin. And essentially what we would do is look at this idea of, or notion of, taking a client's portfolio risk, right, and dividing that by the net liquidating value, or we'll call it equity, right? And then multiplying that by the leverage. So folks that had 80, 90% of their equity at risk and were 4 or 5 times leverage would hit the higher part of the scorecard. the range was like 0 to 7. The mean was around 2. So now we could really take those guys who are in the 5, 6, and 7s and concentrate on them towards the start of the day or at the end of the day. I hope that answers your question.
Yeah, it does. I appreciate that. And I think what's interesting about this panel is we've got folks that represent all of the different sort of sectors here. So Terry, from your perspective, I know you guys have a lot of prop traders. So how do you sort of, view risk and strategies?
So I have a unique set of perspective, which is starting my career on the clearing side of things and working for Goldman and being in the biggest prime brokerage space. Had that background similar to Freddy, where that's how you kind of monitor the start of day and intraday risks. But on the opposite side of the fence, now that I'm on the trading side of things, the perspective is similar. We look at a lot of different factors on how we measure our different exposures. So we run pretty much every trader through several different risk factors, anything from the very simplistic Greeks that you might calculate for each and every trader, such as delta and gamma, which is really sort of measuring the directional, directional risks or exposures that a particular portfolio might have. Getting even to the next layer, which is looking at the volatility exposures or Vega, being able to measure that accurately and look for certain things that are even more sophisticated, like term structure or skew measurements, where a trader might be exposed to a particular area of a price movement or volatility movement, and then how far out did they bet over the course of several months. So those are some of the other things that we look at. We look at vol, things like that, where you're looking for the speed of volatility and how that can rapidly change some of the other factors that I already previously mentioned. Does a vastly increased or decreased level of volatility change how much you're exposed from a delta and volatility perspective? And then some of the other things we look at is, when things are going, very slowly and there's not a lot going on in the marketplace and it's a slow grind, looking at theta, so your overall level of decay, how much premium are you carrying in your portfolio? So we look at that in each and every one of our portfolios. And for guys that are not trading necessarily option-centric books and are just mainly focused on either futures or trading strictly equities, we're looking at for things like the liquidity profile of that book. How big is their position? How much concentration do they have in a particular security or a sector or things like that. So we do a fairly large and extensive review of each and every trader on our book on an everyday start of day basis, and then all throughout the day to making sure.
And Terry, are you using multiple systems here, or have you found the sort of one-stop shop for all, or you're really looking at multiple screens to manage all this?
Definitely looking at multiple screens, and that's I think it's the next part of our topics. But specifically, the reason for that is that a lot of firms out there do certain things really particularly well, but there's not a great, I'd say, a great solution out there for an all-encompassing one-stop shop to do every asset class real time. It's a very big, tall task to take on. As we all know, but we definitely rely on a bunch of different things. And not only that, it's just also from a redundancy perspective. Should there be a system-wide failure or something, you want to have a backup system as well.
Thanks, Terry. And then, Nicolas, from your perspective, as the new clearing firm on the block, what's how are you guys going to sort of view risk and strategies?
Well, and that's very interesting to see the two flavor of risk, right? The first one is a pure market risk, and we can really get granular in how you want to look at the risk by looking at the various Greeks, by stressing the portfolio, whether you go 3 volt, 10 volt, 15 volt, or you go after multiple days. And we have these tools from various providers. But I think one element that we look at very closely being part of a smaller clearing firm is what we call the operational risk. Does this customer add risk to the operation? And when I'm thinking operation, I'm thinking liquidity risk, cash flow risk. Some strategy might, from a market point of view, might have zero risk, like the conversion might have zero delta. However, from a clearing firm point of view, will generate significant risk with the clearing agencies, at least between the time the trade is done and the trade is settled. So those, what we're looking at is really the market risk in real time, as well as having real-time analysis of the operational risk and the cash flow risk.
Great. Yeah, I appreciate it. I mean, clearly you each have your different perspective, but I think the common theme is that risk is super, super important to the day-to-day survival of all of your firms, right? So next question here, which is, I think, relative to the world we're living in today, is how has COVID-19 really changed the way you're monitoring risk? Obviously, a lot of you are from home. Are your hours the same? How are you doing the same thing you were pre-COVID? And Nicolas, I'll start with you since I ended with you.
Sure. The COVID-19 is more, I would say, from a clearing point of view, didn't have a big impact, right? We're built to basically be very resilient, to be reliable, to have multiple locations that we can work from. So whether it's COVID-19 or your office blows up, you need to be up and running no matter what. So from a BCP point of view, and having the luxury of being all cloud-based at Volant Securities, working from home or working from the office where all the systems are running in the cloud, it was really a non-event for us.
Great. And what about you, Freddie, from your past experience?
Yeah, thanks. I think it's really, to Nick's point, I think it's 2 points. So this really put to bear folks or systems that are cloud-based, right? So if you can access them anywhere, that's really important. When you're not spending so much time trying to get into a VPN, trying to get into or access some system that's being held up in some server somewhere where you can't access it. Then I think the other piece would be volatility. Volatility is screaming right now. So for risk managers, having instruments, a dashboard, if you will, where you can really see what's happening intraday and end of day, especially with volatility, is big.
Yeah, no, I think that's important. I think, from our experience at Sterling, having the ability to access your systems via the cloud or even web-based is a huge advantage, especially when you're working from home. So Terry, you've got the traders, your day-to-day. How are you managing this situation, tick by tick?
It is a great question. And I think since the beginning of the outbreak, really what we've done is we've had obviously a much more heightened focus on all the different elements that I had previously mentioned. So paying very close attention to our exposures for volatility. Typically, we're not, a directional type of firm. We don't take a lot of that type of exposure for market movements, but obviously market makers and proprietary trading firms are skilled at managing volatility risks and taking the risks where appropriate. So being ultra focused on this has been one of our ultimate priorities anyway, but I think we put an extra level of focus on this because, like Freddie said, volatility has been screaming in pretty much every single asset class. So there's been particular emphasis in paying attention to even closer detail for a lot of these different things. I think, from our perspective, nothing has changed as far as the way we look at it, like I said, but obviously, really scouring the dashboard and making sure nothing interesting pops up on a daily basis. We've made this transition and positioned ourselves to be, using a lot of technology to work as a virtual office anyway. So we've been doing this for the past couple of years. Hasn't really affected the way we access things because, Sumo takes or does business on many different exchanges, and our traders are pretty much located all across the country and in the world. So, that hasn't really made any impact. I will say though that the travel has definitely been cut down for us visiting different traders in different locations. I would frequently go into the office in Chicago to make sure that everything is working seamlessly there. And that has definitely stopped, as we all know. But what that has basically done is it's made the heightened and increased time in the home office, and our hours are probably even much longer because there's no travel times. You're 100% dedicated to what you're doing on a daily basis.
A lot of these Zoom calls.
Exactly.
So one quick question. Do you feel like your clearing firm has been more engaged? Are you hearing from them more often than you historically did sort of pre-COVID, or has it remained the same?
I think, like in any situation, clearing firms, as we all know is they definitely check in on you, probably a little bit more focused during really heightened volatility periods. But I'd say, I mean, we clear everything through Goldman and EDF. So those guys have always been very, close to us and making sure everything is great. So it's a great working relationship with both firms. So nothing really has changed there.
Great. So last question for everybody, and this is sort of around what are your pain points with monitoring risk and margin on a daily basis, and what would you like to see change in the next 3 to 5 years? I know each of you have a different view because we've got a clearing firm, we've got a trading firm, we've got the retail and clearing experience as well. So I guess Terry, since I ended with you this time, I'll start back to you. What are those pain points, and what would you like to see change in the future to make things smoother and easier for you?
Another great question. I think some of the frustrations we have typically with vendors has been, I guess, data files and accessing market data in some instances has been challenging. And it's not necessarily a problem from any of the vendors or providers. It's been wrestling the beast of managing multiple different types of data flows from pricing vendors and exchanges and option markets. And because the markets are so bifurcated, getting a consolidated flow of market data has been a challenge for just about everybody. But getting a reliable set of data, markets being in a very highly volatile state also make it more difficult, with markets being much wider. So trying to find an accurate price sometimes is challenging in these types of markets. But I think assembling that all under one roof, like in a firm like ours, where we trade everything under the sun from the equities markets and options markets, including that for any and all futures, it's difficult to assemble that all under one rooftop and being able to do it really, really well, because there are so many different challenges and no market is the same. So being able to have a system that can look at every single one of my traders, every type of asset that they trade, and being able to not only present it in such a way where you can look at the various risks that I had spoken to earlier, but being able to then take that to the next step and next level, which is then boiling them down into their own each and every category. As an example, you can't shock or stress or look at risk the same way for Apple or Google as you have to look at it for, let's say, corn, soybeans, or crude oil, or anything like those markets. So each and every market has its own unique and esoteric version of risk that you have to look after. So being able to kind of cut and slice through all of those different elements is a huge challenge. I'd love to see some firm tackle that and put that under one roof, like I said. It took us several years to implement something like this at Goldman. It was a big challenge. We had lots of developers and quants that were fantastic at building this stuff, but it did take us some time to get the right model in place. So I certainly respect the fact that it is hard and it's expensive to put it in place, but that's one thing I would love to see. And I guess the other thing is really just making sure that data that they get in is rock solid, because it's the whole adage of making sure that the information and data that you get into the system is super accurate is the most important aspect.
Yeah, look, and I can tell you as a vendor, right? It is a definite challenge when you're managing, different asset classes, different QSIPs, market data in. Your market data in is only as good as your market data out and your delivery out. So we know those challenges as well, and we battle them on a day-to-day basis. So thanks for that. Nicolas, what about you?
Yeah, and I agree with that, right? The data is by far the most important part and the biggest pain point of the clearing firm. Now, I will also go into the being able to manage your risk and how you communicate with your correspondent. We're building a corresponding clearing firm, and ultimately your customer, being able to have this flow from the clearing firm that finds there's a pocket of risk to passing it to the correspondent, to passing it to the customer can be challenging sometimes. And so what's very useful these days in this risk system is to be able to identify first the risk. There's 100,000 of accounts that are all trading. Which one require attention? Once you've identified the risk, how do you actually drill down through that? Understand the strategy. It's not like you understand every single strategy by just looking at it. So you need to look at it, being able to stress it, get the characteristic of the strategy. And then I would say step 3, which today I'm not going to say lacking, but I think that's part of the next generation, which is the next question. But how do we mitigate that risk? What tools do we have today to come up with hedges to a specific risk? And I would say today those are the main pain points.
That's great. And I see Freddy, who's going to have the last word, agreeing with you and nodding his head. So Freddy, for the last word for the first risk roundtable, let's have your response.
Thanks, Andrew. Yeah, I agree completely with both Nick and Terry. When you think about it, the risk manager is that one point of failure, right? We're trying to manage disparate systems all over the place, feeding in data and trying to consolidate the data and put it in a format that we can analyze, right? Call it a dashboard or your cockpit, right? And that's a big issue. That's a big problem, especially when you have, trying to watch hedge fund managers, robo-advisors, proprietary trading firms, rolling up the data sets, waterfalling it down, trying to find out what instruments are posing risk. That's a huge undertaking, and I agree completely. I don't think we've found the right vendor yet. Hopefully there will be one up and coming that can manage it. And the second part of it, what do I see in the future? I think artificial intelligence is going to play a big role in this. You can't have one person trying to capture everything. It's just, like trying to drink from a fire hose. It's just too much data and too much information. If we could utilize artificial intelligence to say, hey, listen, these are the parameters I'm looking for fixed income risk and for structured product risk or for international, whatever the case may be, that would help a risk manager do his job. Now he can focus on those few things. And we know, Terry knows this and Nick knows this. There's only usually going to be a few guys, the bad guys, that you have to watch out for. Everyone else is usually going to be tucked in. And if you had an instrument or an algorithm that could help with that, that's going to be the big next gen thing. That's my response.
Well, what I would say is, why don't the three of you come up with the spec, and then Sterling can take it from there. But listen, I appreciate all of you jumping on our first risk roundtable, and I appreciate your thoughts and your input. And I just wanted to say thank you to everybody for being here. So thanks a lot.
Thanks for having us.
Thank you very much, Andrew.
Thanks, everybody.